So, hello everyone, welcome to Peterson and Partners Fire Chat. And today our guest is Kimmo Rytkönen. Kimmo is a serial entrepreneur, founder and CEO of Income Marketplace. Welcome, Kimmo.
Thanks, Evita. Hi, everyone.
Yes, so it's been exciting to observe your path as an entrepreneur, and obviously we have worked together on several assignments throughout these years. So why exactly peer-to-peer lending now? How do you see potential for this business, and why did you decide to go into this niche of fintech?
Well, I mean, peer-to-peer obviously is not a new thing for me in that sense. In the past career in consumer lending, we were onboarded on one of the larger ones, Mintos, and so we've been following that space quite a bit already for years, and then after my last exit, I thought that something else, and providing funding for fintechs, and then of course also to providing service to investors in a better way that has been done before. Then those two things kind of came together, and that's where the idea of Income Marketplace came.
And if you say in a better way, what would be different?
Well, I mean, it kind of boils down to investor security, and that's something we're here to improve. That a lot of the marketplaces have been lacking in the way they secure the investments, and consequently we've seen a lot of frauds in the space in the past years, and that's just been bad for the whole industry. And obviously in my career and with my co-founder Mick, we gathered through the years kind of the idea of how do the institutions secure the book, how do the institutions that invest into loans, how do those secure their investment, and that's something that we wanted then to replicate in the peer-to-peer space, to make it sure that investors wouldn't lose money when they invest into loans. I myself, one more thing, I'm an investor in loans as well, and I really like the asset class. The cash flow aspect, the quick ramp down once you stop investing. There's a lot of things talking in favor of loans as an investment class, but the security part was missing, and that's what we're aiming to fix.
Yes. I saw in some of your articles and speeches talking about skin in the game, and I wanted to tag on that since there is a bestseller by Nassim Taleb, and then when he talks about skin in the game, he actually means it, for example, comparing to how unfair judges were treated in old times, that they were skinned and the chair for a new judge was made of that skin, as well as how unprofessional builders were treated. Basically, if you build a house and it collapses, it's a death penalty for you as a builder. So what does skin in the game mean for you in Income Marketplace? And maybe if you could also answer, and what is it for the bankers, for banking industry, as a difference?
Yeah, it's a good question. I mean, skin in the game has become sort of a standard term in peer-to-peer. And if you look at traditional finance, it effectively, or for bankers, as you say, it means that you hold a share, or the owner of an asset holds a share in it while others invest into it. And the idea there is that it aligns all the parties, in that investment. So if you look at it in loan terms, then you see marketplaces saying, okay, we have 5% skin in the game. What it essentially means is that you have 5%. The loan originator holds 5% of the loan, and the investors invest 95% of that loan. And the assumption is that this alignment tool keeps the loan originator from doing anything wrong, or keeps the quality of the loans well, because they also have the so-called skin in the game. Now, yes. This has been, and like I said, this has been pretty much the standard terminology for peer-to-peer, and then quite successfully so. I mean, peer-to-peer has, if I take a little bit wider view, there's been two things. One is buyback guarantee, which has been highly successful, and then meaning that the loan originator buys the defaulting loans back from the investors, and then skin in the game. And I think with these two elements, the peer-to-peer sector has grown really fast, really well. I mean, even if we're looking now with peer-to-peer market data, great site for tracking competition, but also the overall market. They are funding in the last 90 days like 1.2 billion euros only in Europe. That's the volume that goes through into loans. So good scale, massive scale there. But skin in the game, like I said, yeah, it's an alignment tool only. And I actually wrote a blog post about it. I think you referred to that.
Yes.
And that's basically explaining what does income marketplace do differently. So we actually call skin in the game a junior share. They are sort of similar terms, but if there's a problem with the loan originator, then actually the functionality is different. So in our case, the junior share is subordinated to the other investors. So it acts as an alignment tool, but also as a security. So if you think now that in a skin in the game situation, a loan originator has a 5% share, as I said, and the investor's 95%. Now, if something goes wrong, the loan originator walks away with the 5%, and the investors walk away with the 95%, and they split the loss equally, proportionately to their share. Where junior share comes into place, and this is how the institutions look at it, is that this share is actually subordinated to the rest of the investors. So if something goes wrong, the 5% is first wiped out, and only then the investors start losing. So this is a sort of an institutional level security concept that we took into play, and we used to call it skin in the game as well, but because the functionality is so different, even if a similar term, then that's why we recently changed it to reflect the reality better.
Yes, excellent. Thank you for this explanation. And then I was wondering about your view on the DeFi. As we have heard, this is an extremely topical question during the last year and this year. Now that there is billions of assets locked into the system, and that this technology and this architecture obviously enables and allows market players to interact without intermediate party whatsoever, be it a bank, FinTech, or any other intermediary. So how do you see this affecting income marketplace? Do you see it as a threat or opportunity for you?
Well, I mean, I kind of see, DeFi as DeFi and blockchain as such. What you're referring to, I see it as a tool for transacting. So for those who are not maybe familiar with it's decentralized finance, and what the idea is that through smart contracts, meaning that contracts that trigger when some terms are met. And blockchain, meaning that there's a ledger that can't be changed afterwards. So we through those two chains, those two elements, you can actually go past banks and you can go past intermediaries. So that's why it's decentralized finance. So why I'm saying it's a transactional tool rather than a threat to income is because. Yes, sure. Through DeFi, you can agree to buy a loan, or you can agree to give a loan and borrow a loan. But there's a whole lot of work that actually goes into on the background to actually make the loan investable, like what we do. So somebody needs to, if you may call it, tokenize the issued loan before it can be transacted with. And that's basically what income is doing at the moment. So we look very hard on the quality of the assets before they are placed on the platform. And there's a lot of work goes into the due diligence of the loan originators to make sure that the assets really exist, that they are solid, and so forth. So somebody has to do that heavy lifting. But after that, for sure, DeFi could be used to transact with those loan assets that all carry an interest yield and so forth. So where I see DeFi as a very interesting part is the ability of an aftermarket. So once a company like Income has done the heavy lifting, taken the assets to the platform, and should we tokenize them one day, which could also be an option, then anybody with, for example, an Ethereum wallet could actually be buying them and transacting with them in a very simple fashion.
Yes.
So I see it as a technical solution more than a replacement for what we do today.
Yes, excellent. As far as I have seen, DeFi doesn't offer non-collateralized lending whatsoever. So this is only a technical tool. Nobody looks at these loans as you do, or loan
Correct.
originators.
Yeah,
so
exactly.
You need to come already with some money in order to take another loan.
Exactly, and that's where the smart contracts actually come into play, is that basically you agree that I take a loan from you and I have to pay it back at a certain time. If I don't, then, for example, my crypto assets are liquidated to cover for that loan. So that's where the smart contract, what I was mentioning, is that if certain terms are met, then something follows. And thus it works if you have a collateral. But like I said, we mostly transact in non-collateral loans on a global scale, finding loan originators or fintech lenders from Brazil, from Indonesia, and then we assess the book and we place them on income marketplace. And this is something that DeFi today at least cannot replace. So I really don't see it as a big threat.
Right. What was interesting though about DeFi that the enthusiasts claim no need for a regulator, because algorithm is not cheating, bribing, and possessing other evil traits of a human.
Yeah.
So that was interesting observation. You mentioned Brazil, Indonesia, and now that we cooperated in searching for loan origination agents for you all around the world, it was quite amazing that you take the whole world at one go, while maybe other startups and scale-ups take it a bit more humble. So could you highlight your expansion strategy all at once, or in waves, or how do you plan it?
Well, it is kind of all at once, because the loan assets exist all around the world, and to be fair, emerging markets have a more attractive yield profile. So we could go after, for example, German peer-to-peer, go through all the regulation there and try to onboard them. But the yields are probably far less if you look at the likes of Oaks Money, 5%, so forth and so forth. By the way, all of these guys also aim to somehow, especially those who service institutions, they do try to secure through Luxembourg structures or otherwise, they try to secure the loans as well. But yeah, the yield profiles are not so attractive, and we just looked at it that pairing emerging markets, although we do have a loan originator from Finland as well, but pairing emerging markets, going through the due diligence, building the security structures, for example, in Indonesia, that'll be an interesting concept also for the investors, where risk and reward, if you may, matches better than perhaps in developed markets. So it is an all at the same time strategy, but also because there are hundreds, if not thousands, of loan originators globally, and where we cooperated was exactly to find the right people, to find the right loan originators for us. So generally, it doesn't necessarily mean maturity, but it means those that have sufficient data quality and sufficient know-how of running their business, that we can confidently say, hey, investing in this one is safe. We can onboard with the security structure. We can onboard them on income.
Yes.
So that's the approach.
Excellent, Kimmo. So good luck with everything. You are obviously on a great mission. So for those with money, you allow to make it work, and for those developing their businesses in many markets all around the world, you give access to liquidity, you give it fast, you give it fair, transparent. So fantastic mission, and good luck with major success with this new venture.
Very good. Thank you, Evita. Thanks for hearing my thoughts.
Kimmo. Thank you.
Thank you.
Bye.
Bye.